So the producer price index was out for August and it came out yesterday morning. This was kind of a shocker to me because usually the PPI comes out before the consumer price index. And the CPI was not meant to come out until Tuesday. So Tuesday on September the 14th at 8:30, we're going to get the consumer price index reports. So I found this very interesting that the producer prices came out. It took me a little bit off by surprise, but I guess that's what it goes to show you for just assuming that it would follow the consumer price index the following day or two instead of looking up the schedule for the releases. In any case, let's go over this report, and there's a lot of data to digest here, as well as update my consumer price inflation model to give us a better outlook of what to expect for the end of the year and then going forward into the coming year. So the annual yearly producer price inflation is beginning to peak around here at about 20% inflation, give or take. And so now, if you remember, my rule of thumb is that it tends to be that for the past 20 years that when we see high spikes in the producer price inflation, roughly 1/3 translates into a consumer price inflation number, roughly, give or take. So it looks like that if we do peak at about this 20% number, and it looks like we might, then we should be seeing a consumer price inflation of roughly 6.5% to 7%, at least 6%. On the minimum 6%, maybe on the high side 7%, and could be going up forward. Now, in the next sets of data that I'm about to show you, I'm going to kind of counter that narrative. And the reason why is because I believe that special circumstances are developing that are going to actually press up that consumer price inflation number beyond this 3-to-1 relationship. And I'll try to explain what my reasoning is as the basis for that, because the last thing I want to do is mislead you into thinking that it's like, oh my God, we're going to have all this high consumer price inflation and I'm just being a perma bear. And then if it doesn't manifest, it's like, well, thanks for telling me something that's not really going to happen, whoop-de-doo. So when we take a look at the same charts, and again, this is the producer price index for all commodities, on a monthly change, we begin to see a calming down in this inflation rate. Now, if you notice this about, a week or two ago, I produced a report that said that, commodity prices were beginning to stabilize a little bit. And I believed that this would overall start to influence that producer price index change. So we're getting a high inflation number. Let me be clear here. This 0.73%, that's in 1 month. So on an annualized basis, that's a 9% inflation rate for producer inputs. That's not good. That's very high, as a matter of fact. I mean, if we take a look at the monthly change right here, that's still really, really elevated here. And if we take a look at the annual inflation rate for producer prices, the annual inflation rate here is the highest that we have seen since the 1970s, I think, right? Yeah, since the 1970s, this is the highest inflation, even surpassed what we saw in 2008, and that was with skyrocketing gas prices. Now, don't get me wrong, gas prices are pushing over $3 a gallon, but back in 2008, we were seeing gas back in 2008, mind you, of $4 a gallon at least. It was terrible. So, the fact that we're seeing all of this in the commodities prices is just illustrating the severity of what's going on in our economy now as companies are getting hit with pressure squeezes, which is hurting their gross margins. And if it's hurting their gross margins, it's going to hurt their profits. And that leads to detrimental economic growth because it leads to less investment over time. Now, when we take a look at the intermediate goods, which is the earlier stages of production for producer prices, we can see here that the intermediate goods, the prices of basically the raw materials and producing those earlier stages of producer final goods, is really where the crux of the inflation was getting hit. Okay, so part of this, of course, was the shortages, the shutdowns, but also the money supply going into the earlier stages of production. And again, we're seeing the highest inflation numbers that we've ever seen, and this is on a monthly change. This is a monthly change that we've ever seen since the 1970s. So once again, only during the 1970s did we see something as bad as what we are seeing right now on the producer front. Now, granted, this only goes out to June, and the last update was on August 12th. So sometime early next week, we should be getting the update to this for July, and I expect this to start tapering down. But as I said before, we have to see this dropping down in the earlier stages to filter down to the later stages, which is what we really care about for the final demand goods, because the final demands, the last stages of the producer price index, is the one where I've been showing you that there's been a strong correlation between that and the consumer price inflation report. And I'll post a couple links to the videos in my description to give you that as a reference here. But final demand's year-over-year inflation has shot up to 0.83% here. So before in July it was 7.7, which was already the highest annual inflation rate that we've had on record. It's now up to 8.3%. And a lot of that is going to come translating into the consumer price inflation. Now, if you remember what I said earlier, I was saying that based off the total producer price index inflation annual rate, we should be seeing maybe a 6.6%, 6 to 7% consumer price inflation. But based off of final demand, which is at 8.3% inflation, we're probably looking at that, at the consumer price inflation, to shoot over 7% before year's end. Could be over 8%, because I don't think that this is the end for final demand inflation. I don't think this is the peak. I think final demand inflation is going to go up higher, and I'll show you the tables and data that kind of support that thesis, and a lot of that's going to come out to the consumer price index, into the consumer price index, and push up that annual inflation. I'll talk about some of the ramifications that I think could manifest from this later on. Now, on the monthly change inflation numbers for final demand, we're seeing a drop here. So final demand last month for July was terrible. It was over 1%. It was over a 1% inflation rate, and the month before that was practically 1%. Now it dropped to 0.7. Well, whoop-de-doo. But that 0.7%, that 0.71% inflation rate, you have to remember, that's still an 8.5% inflation rate on final demand, and nearly all of that's going to come out to the consumer prices. So if nearly all of that comes out to the consumer prices, again, that's looking at high consumer price inflation for the next couple of months. And if you listen to a couple of videos that I made when I was talking about the common commodity prices, I mentioned that consumer price inflation would abate in the coming months. But remember, I also prefaced that to say that does not mean it's going to happen right away. We're still going to get a couple months, at least, probably a few months, of high consumer price inflation, especially on the monthly changing numbers, until we start seeing the calming down in the final demand. What we are seeing is a relatively speaking, calming down in the intermediate goods section. But even then, look at it. The intermediate goods inflation is still sky high. It's going to be a few more months before that really starts to get to a point where it has a relatively downward pressure on the consumer price index report. So I've updated my final demand model. So in another video, I put in that, there's a strong correlation between final demand and consumer price inflation. You can see the relationship between the two here on the index numbers, and we can use that to sort of chart out with, roughly an 85% confidence, a little bit more than that, the consumer price inflation, okay? So for August, I'm showing that we're probably looking at minimum, a 1% inflation number. We're probably looking at that, and it could go as high as 1.4. The mid-range on this is a 1.4% monthly change in the inflation rate, but I think that's a little high, and instead we're probably going to go down to about a 1% change in the inflation number. The reason why I thought that was a little high is because for July's numbers that came out based off the prediction, we were predicting a change of 0.9%, which would put the annual inflation to 5.7%. However, that just didn't happen. Instead we got a 0.5% increase, and it was 5.3. So I think we're on the lower end. There seems to be a little bit of a temporary divergence or distance between the last month's final demand numbers and the current month's CPI numbers. Now, how long will that last? Probably not very long, and we should play catch up as time goes on. And so I think that we'll play a little bit of, we'll probably lose a little bit more lag here because I just don't think that that 1.4% is going to be realized on the consumer price inflation. That's a huge jump. But next month, what are we seeing? Well, we're looking at another big month of consumer price changes based off the new final demand numbers. So we're looking at a minimum of 0.5, a high of 1.5, and actually I think that the likelihood here is that we're probably going to see another 1% jump in the consumer price inflation numbers, okay? So with final demand being tracking out and projecting out to the end of the month, just using the average change in final demand since May of 2020, just taking this average and median change in these inflation numbers, we're looking at final demand popping off and topping off at 9.4%, 9.5% inflation by the end of this year, which is just, this has never been seen before since we've been tracking final demand goods for the past decade or so. It's actually been a little bit more than a decade. It's been about 12 years, okay? What about the producer price index for all commodities? Well, although we're seeing, it looks like that on the chart level, we're seeing producer price inflation top off at about a 20% annual inflation rate. Taking the average and the median projects it out to about 22%. Do I think that we're going to see this? Probably not. I'm just keeping this table because that's what I've been using as the trend. Instead, what I think is that we're probably going to be seeing a calming down effect and peaking around 20% and even maybe possibly start abating and dropping a little bit, okay? So with that being said, shouldn't this be pushing down the consumer price inflation? Well, no, because the final demand is still being pushed up, and I've got good reason to think that those final demand goods are still going to be pushed up, and that's going to realize into a higher consumer price inflation. And just based off of what I think is going to happen with the next 2 months of 1% increase, and then finally a relatively calming down in the consumer price inflation, we're still looking at an annual rate, an annual CPI rate of 8%, over 8% consumer price inflation. And I think that's honestly a realistic number to look at. That's going to be devastating. That's going to be very high. And how that, stocks could be bullish off of this for the last quarter, I'm really not so certain about that. Now, when we take a look at this, based off of the performance here, what we're seeing here is that based off of the historical confidence levels in the US dollar, which would be a 70% confidence level, we're looking like by the end of this year, confidence is going to actually start to shake just a little bit. It does not mean that it's getting into a critical level. And for a frame of reference, we were in the red in confidence during the 1970s. This is when we really did see systemically high inflation year after year after year. Even if you got 1 or 2 years of low inflation, it was compromised by 1 or 2 years of higher inflation either before or after. And this really didn't start to calm down until the 1980s. And even with the 1980s, although there was a relatively calming down, we were still seeing records amounts of debt being pumped out and still keeping that inflation number high. So what's been saving us on this front is that we're seeing a lot of M2 growth go on, okay? So this is just over 2 years, a lot of M2 growth. And on a 10-year projection, we're going to have the highest growth in the money supply, that we've ever seen in history, even surpassing that of the 1970s. But what's been saving us is that debt growth. Debt growth is actually moderating, and that a lot of that, I believe, has to do with the Federal Reserve making banks hold certain amounts of capital, which is financing government debt, but it's cutting short private debt. Because of this is going to help tame that CPI inflation rate, I think, for some time. But even on a high confidence in the US dollar, a 70% confidence interval, then we're looking at 4% price inflation on the average for each year from here on out. And it's probably, since we're going to overshoot a little bit here, we're going to overshoot a little bit in by the end of 2021, assuming that we still maintain that high confidence in the dollar. We're probably going to undershoot in the next, sometime in the 2020s where we get a year or two of, say, 2 to 3% price inflation before it moderates out at 4, because this 4% is just the average annual inflation rate. Inflation rates can fluctuate based off of different circumstances at the time. You got to remember that sometimes you might get a bust in the economy and a recession, which would drop consumer prices temporarily. But that's assuming a high confidence in the US dollar. What happens if we get to a low confidence in the dollar? Well, then based off of these numbers, based off of this projection, this average, we are really quite possibly looking at the 1970s all over again, and that could be very, very destabilizing for the U.S. economy. Now, I've been saying this before, and this is one of the things that I've been wrong on, is that the high consumer price inflation would shock investors and start having them dump bonds, and the interest rates on bonds would go up, despite the fact that the Fed has been pumping money and buying at least the most risk-free bonds, aka government bonds and some mortgage-backed securities, which of course is causing a flight of capital for investors to chase yield, which has been driving down the interest rates for all other corporate bonds, okay? So all other corporate bonds have been driven down now based off of the Federal Reserve. The Federal Reserve buying government bonds and mortgage-backed securities, okay? So just take a look at this. Just take a look at what's been going on with corporate bonds. Now, I did type in junk bonds, but I don't really have time to look at it. But here's the BAA corporate bond yield. So these BAAs are, kind of in the middle. They're kind of in the middle between the high-grade AAA rated bonds and the low grade below triple Bs and belows, which is basically your junk bonds. You see how these interest rates have just been tapering down, and that's because investors are chasing yield. They've been looking at bonds as relatively safe havens, and if you think about it, these interest rates are below the inflation rate. So if they're below the inflation rate, in real terms, the investors are losing money. Well, what gives? Well, some of the Austrian economists and monetarist economists have very much understood that what's been driving investors is investor expectations, and especially expectations about the inflation rate. So right now, what this tells us is that investors are expecting that these inflation rates will calm down. They really do believe this. That's why they're parking their money in assets that are actually yielding negative returns, because there are special circumstances that have developed right now that are temporarily pushing up the consumer price inflation numbers. Let's go over it. You had the government shutdowns of COVID, okay? You've had the disruptions in the supply chains. You've had shortages in certain key good materials. You've had pops in inflation in certain goods, like, say, used cars and other parts of technology, and with the microchip shortage, that causes them to ignore some of the overall inflation effects, at least temporarily. But as Ludwig von Mises, the Austrian economist, has pointed out, which Murray Rothbard has also pivoted off of, as well as Henry Hazlitt, and then the monetarist economist Milton Friedman, inflation expectations can change very, very suddenly. And when they change, it becomes a violent change. It becomes a flight to real goods, a flight to capital, where we see an abandonment of the confidence in the dollar and more of a drive into consumer goods and low confidence in the dollar, as well as a flight into real safe havens like precious metals. So that's the reason why we're not seeing this bull market develop in precious metals, relatively speaking, that I have been talking about, that should be coming, give or take. Instead, we're seeing, there's been a jump in the silver price, there's been a jump in the gold price, right? But there has not been a drive up in the silver price. There has not been the next bull market in silver. There has not been the next bull market in gold. Not yet. Why? Because confidence in the dollar, confidence that this inflation numbers are temporary, is still taking effect. But what were to happen if we were to see these 5.3% inflation turn into 8%? To me, that's got to shake, at least relatively speaking, that has got to shake investor confidence that inflation's temporary. And next year, we're not going to see these inflation numbers just drop all of a sudden to 4%. Instead, we're going to see a kind of calming down. Maybe next year we get, say, a 6% inflation rate instead of 8% or 5%. And then the next year we get 4%, followed by a couple of years of 3% to sort of average it out. And that's just assuming that we get back to this 70% confidence interval. It takes time, it seems, that for investors to try to wake up and recognize that says, hey, wait a second, there's a problem going on. These inflation numbers are not going anywhere. They're still high. We're not getting down to this stable 2% number. And when is that going to be realized? I honestly do not know. It could take years. It really could take years to develop, because one of the things that happened for consumer price inflation back in World War I is that at that time, we had high consumer price inflation during right after World War I, but it did not take place during World War I. And that's a key thing to recognize, because by it not taking place during World War I, when most of the monetary inflation was going on, okay, so take a look here, during World War I, when a lot of the monetary inflation was going on, it instead manifested after World War I several years later, okay? So because of that, granted, we went in and we ramped up huge amounts of government spending in 1917 when we entered into the fray to put an end to the stalemate between the Allied powers and the Central powers of World War I. Look at these inflation numbers. The Federal Reserve at this time was created back in 1913, and we were creating money at this time. We were having high monetary inflation, but it did not start picking up for a couple of years after we started having this high monetary inflation. Could we be seeing such a situation develop again? Yes, and this would have a detrimental effect to the stock market, because the stock market did not correct itself until the late 1918s, 1919s, when it became realized that the inflation numbers were not going anywhere, okay? This is when you started to have a problem develop where investors were like, hey, wait a second, these inflation numbers, they're not going down, this is real. And we could be seeing a similar situation to develop that today. That's when the flight to real values will commence. That's when the flight to gold will commence. Until then, we're just waiting for this out. Now, hopefully speaking, this does not happen and investors maintain confidence and write this whole thing off to COVID. They are writing it off to COVID right now. But how long will that be before investors get impatient and grow weary of the same old rhetoric? We do not know. Honestly speaking, we just don't know. So place your bets where they may, where you think it will land. There's good arguments to say that we could still see a run-up in stocks after the current abatement of stocks in September. There's good arguments to say that we could, in the long run, see a push-up in precious metals. I do think the long-run game is the more important game out of this. There's other reasons to go into that, most importantly that we've blown up a credit bubble and that could cause instabilities in the economy. But that's a video that I'll cover in another day. So guys, thank you for watching this video. If you like my content, click that like button, show me some support, leave a comment down below. Let me know what you think about all of this. Any questions that you have, I'll be glad to answer. Subscribe to my channel, click that notification bell so you're notified whenever I upload the next video. And I'll probably be uploading another video at least this weekend before those consumer price inflation numbers come out on Tuesday. So guys, I'll talk to you then, and thanks for watching.